Hai, Assalamualaikum warahmatullahi wabarakatuh. My name is ADIB.
My name is HAMIDI. My name is HUSSAIN.
Guys, so what are we going to do today?
Okay, we are going to discuss two Mfrs in two parts, Part A and Part B. What's in Part A, Midi?
So part A will covers MFRS 8 operating segments.
Oh, what about Part B?
MFRS 134 Interim Financial Report.
Midi, how about you start first?
Sure. Come. This place is so noisy. Let's go somewhere quieter.
Let us begin with MFRS 8. The standard score objective is highly focused. It mandates disclosures that allow investors to evaluate the nature and financial effects of a company's business activities. Essentially, it answers the question, where does the company make its money and what risks does it face? The foundation of this standard is the management approach. This is a user-centered perspective, meaning we report segments exactly as internal management reviews them to allocate resources and assess performance. This ensures external reporting mirrors internal decision-making, giving users a true, unfiltered view of the business structure. Finally, MFRS 8 dictates what must be included in the report. Beyond the segment's financial performance, companies must provide entity-wide disclosures such as breaking down revenue by geographical areas and disclosing information on major customers. This holistic picture is vital for comprehensive risk analysis. The central figure in MFRS 8 implementation is the Chief Operating Decision Maker, or we call CODM. This is defined as the function, be it an individual or a group, that reviews operational information to define and assess the performance of the segments. Their decisions revolve around allocating resources and setting performance benchmarks. This leads us to our first example, which is YTL Cooperation Berhad, which exemplifies a group CODM structure. Given its vast diversification, from utilities to cement and hotels, resource allocation is inherently a collective decision. We see this function performed by the Senior Executive Management Team, which is anchored by the Executive Chairman and Managing Director. In stark contrast, we have Top Glove Cooperation Berhad, where the CODM function is centralized under an individual, which is the Managing Director. In specialist industry, like glove manufacturing, this individual is the singular point of review, setting strategy for capacity expansion and operational performance across all facilities. Now, we will address the two primary types of segmental reports required by MFRS 8. These reports are fundamentally differentiated by the type of information they provide to the users. The first type is the operating or business segment. This disclosure is mandatory for every company to detail the performance of its different products or services. This helps external users to identify which specific business activities are the primary drivers of profit or loss. The second type of segmental report is geographical segment report. This is essential for users to assess specific political, regulatory, and economic risks associated with operating in different regions. To relate with operating or business segment, look at YTL Corporation. Their snippet clearly segregates performance by activity, which is construction, cement, property, hotel, operations, and utilities. This allows us to instantly see that utilities and cement are the main revenue generators, providing clear insights into the company's core drivers. To relate with the geographical segment, Top Glove Corporation explicitly states that its primary reportable segments are geographical. Their table shows revenue and results broken down by markets like Malaysia, Thailand, and Vietnam. This is vital for users to evaluate how currency fluctuations or localized labor costs in these countries impact the group's overall profit and assets.
Okay, next I will move on to question 4, where I will briefly explain on two key benefits of segmental reporting under MFRS 8, with example of Malaysian listed companies. First, segmental reporting gives a better understanding of a company's performance. It actually shows which part of the business are doing well and which parts are struggling. We took some WS as examples, where it reports revenue by geographical segments. As you can see, it shows which country has the highest revenue. With this information, investors can clearly see which regions contribute the most, helping them identify growth areas and potential risks. Second, segmental reporting improves transparency and accountability. It allows users to see how management allocates resources and how each division performs. For instance, RHB banks report by business segments like retail banking, wholesale banking, and insurance. This helps shareholders evaluate whether each segment is performing as expected. and increase confidence in management decision. If I had to conclude, segmental reporting actually helps users understand performance more clearly and strengthen transparency across the business. To show that that I did not make things up as evidence, these 2 points actually are supported by the PwC Insight report on Mfrs 8. Now we move on to part B, MFRS 134 Interim Financial Reporting. I will explain shortly what MFRS 134 is about. MFRS 134 or Interim Financial Reporting provides the guideline for preparing financial statement for periods shorter than a full financial year, such as quarterly or half-yearly reports. So the main purpose of this standard is to give users timely and reliable updates on a company's financial performance between annual reports. Under MFRS 134, companies, especially listed companies, must use the same accounting policies as in their annual financial statements. They also need to present key components such as condensed statement of financial reporting, financial position, profit or loss, cash flows, equity, and relevant explanatory notes. In short, MFRS 134 ensures that investors and other users can access the company financial health and performance throughout the year, not just at year-end.
For the second question, we were asked to identify 2 significant events and transactions that affect an entity financial position and performance. To answer the question, we will refer to Interim Financial Report of Maxis Berhad to find the significant event and transaction. The first event in Maxis Berhad Financial Report actually happens after the current quarter, which ended in 30th September 2025. The event took place on 3rd October 2025, where the company enters into an agreement with Malaysia Communication and Multimedia Commission (MCMC) for a spectrum assignment. Maxis Berhad is required to pay an upfront of 100 million ringgit and an annual payment of 300 million ringgit for a period of 12 years. The second event is Maxis Berhad issued 1,964,400 of ordinary shares under the LTIP. So, what are the effects? For the first event, Maxis Berhad would record an intangible asset of 100 million ringgit, which is the amount of upfront payment. When the upfront payment is made, Maxis Berhad's cash would decrease by 100 million ringgit and the liabilities will increase since there is annual payments. For the second event, the amount received from investor is recorded under share capital, making the company's equity increases. With the amount received, Maxis Berhad can improve their future performance by investing the fund properly. For the last question, we were required to identify the interim reporting period for both the current and comparative interim financial reporting. Using the same company, which is Maxis Berhad, we will first take a look at the statement of profit or loss and other comprehensive income. For the individual quarter, the reporting period is 3 months, ending, which is from July to September. The current interim report is from 1 July 2025 to 30th September 2025, while for the comparative is from 1 July 2024 to 30th September 2024. For the cumulative quarter, it is 9 months, ending, which is from January to September. The current interim report is from 1 January 2025 to 30th September 2025, while the comparative is from 1 January 2024 to 30th September 2024. Next is the Statement of Financial Position. For the current interim report, it is as at 30th September 2025, while for the comparative, it is as at 31st December 2024. Next one is Statement of Changes in Equity. For Statement of Changes in Equity, it is cumulative, which means it takes the transaction from January up until September. So for the current interim report, it is from 1 January 2025 to 30th September 2025. While for the comparative, it is from 1 January 2024 to 30th September 2025. Lastly, the Statement of Cash Flow. It is also a cumulative, so it is 9 months ending. For the current interim report, 1 January 2025 to 30th September 2025, while the comparative is from 1 January 2024 to 30th September 2024.